Hello, and welcome to an exciting overview of financial accounting, where I will explain what financial accounting is, how it differs from managerial and tax accounting, and importantly, who sets the rules for financial accounting in the U.S. economy. In other videos, I will provide an overview of the basic financial statements, how investors use the information these statements provide, and summarize how the financial statements articulate. That is, how the balance sheet, income statement, and statement of cash flows relate to each other. Buckle up, my friends. This is going to be fun. When people hear the word accounting, they often think of filing their tax return or of a family friend who keeps the books for a small business. While it is true that these are examples of accounting, they are not the type of accounting we reference when we say financial accounting. Financial accounting is the financial information that managers prepare for their investors. The purpose of financial accounting is to help investors evaluate companies' economic performance so they can make profitable investment decisions. In contrast, the aim of tax accounting is to assess the amount owed in taxes and often to minimize, within the law of course, the amount of taxes paid. Managerial accounting refers to the use of accounting information to make business decisions, and Accounting Information Systems, or AIS for short, considers the design of systems to collect, aggregate, and analyze accounting data. AIS is the basis for collecting data for use in financial, managerial, and tax accounting. Not only do these types of accounting differ in their purpose, they also differ in who sets the rules for the accounting. In the U.S., Congress sets the tax rules and the IRS enforces the rules. Managerial accounting aims to provide useful information for internal decision-making, and thus there are no rule setters for managerial accounting, only best practices for presenting information in a way that makes it useful for decision-making. In the U.S., public companies are required to prepare their financial statements in accordance with U.S. Generally Accepted Accounting Principles, referred to as GAAP. Generally, U.S. GAAP is set by the Financial Accounting Standards Board, but the Securities and Exchange Commission, commonly referred to as the SEC, actually has authority to set U.S. GAAP. Currently, the SEC has chosen to delegate most of the rule-setting process to the FASB. To better understand the relation between the FASB and the SEC, a story is helpful, not a love story, but a story with a big problem and a solution. Let's assume that I start my own business by using my savings to purchase a computer and some advertising. I also plan to manage my business. In this example, I am the owner and the manager of the company. If I prepare financial information, it is to inform my business decisions and make sure I pay the right amount of taxes. I do not need to prepare any extra information to help investors assess performance of the company because I am the only investor and the manager, so I know what is going on with my business. Let's assume that after a few years, I want to expand my business. The only problem is that I do not have enough of my own money to expand. So I ask others to either lend me money or to become owners in the company by providing the company with cash in exchange for ownership in the company. My friends and family might invest based solely on their trust in me, but if I needed more money than they could provide, I would have to ask others to invest. The potential problem I face is that the investors in my company who do not know me have to trust that I will manage the company well and generate for them a return on their investment. I might decide to take their money and then not work hard or use their money for personal items rather than for running the business. For example, I might use the money to install a pool in my house. Although a pool would make my family happy, it would not benefit the investors. We refer to these types of problems as agency problems because the manager, who is an agent for all of the owners of the company, may sometimes act in her best interest to the detriment of the other owners. One way that the manager could easily do this is to report a rosy picture of the company's performance by stealing money or mismanaging the company. To avoid this problem, a manager could commit to use a specific set of accounting rules and agree to have an independent third party evaluate whether or not the manager prepared the company's financial information in accordance with the rules. In fact, this is exactly what we do in financial accounting, but this is not always the way it has been done. Prior to the establishment of the SEC in 1934, companies were not required to prepare and disclose financial information using standardized accounting rules. During this time, investors were tempted by promises of rags to riches transformations and easy credit, and thus most investors gave little thought to the systematic risk that arose from numerous sources, including unreliable information about companies' economic performance. This did not seem to be a problem in the 1920s as prosperity boomed and the Dow Jones climbed. In October of 1929, the Dow Jones dropped substantially. The stock market crash of 1929 was not the sole cause of the Great Depression, but it did act to accelerate the global economic collapse. By 1933, nearly half of America's banks had failed, and unemployment was approaching 15 million people, or 30% of the workforce. The devastation motivated regulators to act. When the stock market crashed in October 1929, public confidence in the markets plummeted. As a result, sentiment changed, and there was a consensus that for the economy to recover, the public's faith in the capital markets needed to be restored. Congress held hearings to identify the problems and search for solutions. Based on the findings in these hearings, Congress, during the peak year of the Depression, passed the Securities Act of 1933. This law, together with the Securities Exchange Act of 1934, which created the SEC, was designed to restore investor confidence in our capital markets by providing investors and the markets with more reliable information and clear rules of honest dealing. The main purpose of these laws can be reduced to two common sense notions. Companies publicly offering securities for investment dollars must tell the public the truth about their business, the securities they are selling, and the risk involved in investing. People who sell and trade securities, brokers, dealers, and exchanges, must treat investors fairly and honestly, putting investors' interests first. Congress established the Securities and Exchange Commission in 1934 to enforce the newly passed securities laws, to promote stability in the markets, and most importantly, to protect investors. Thus, one aspect of the U.S. response to the crash was to increase disclosure. The idea is that if investors have high-quality, accurate information, then they can make good decisions and the best companies will garner the attention of investors. To do this required a common set of accounting rules. Thus, a standard-setting body was needed. A few iterations were attempted before the FASB was established in 1973. Currently, the FASB, a quasi-private organization, sets U.S. GAAP at the discretion of the SEC, who ultimately has authority to set U.S. GAAP. Not all U.S. companies have to use GAAP because not all companies have public investors. Generally, public companies that have stock traded on exchanges like the New York Stock Exchange or the NASDAQ, are required to prepare financial statements in accordance with U.S. GAAP and file the financial statements with the SEC. The SEC requires public companies to file financial statements 4 times each year, 3 quarterly and 1 annual report. The quarterly filings are called 10-Qs, and the annual filing is the 10-K. Before filing, a firm has its annual statements audited and its quarterly statements reviewed by its independent auditor. That is, auditors conduct an independent examination of the financial statements to determine if they are fairly presented in accordance with U.S. GAAP. Did you know that you can find public companies' financial information in numerous places? The easiest place to locate financial information is on the SEC's website, but other public sources include press releases and conference calls hosted by the company, and industry reports, and also information from analysts who follow the company. Remember that the objective of financial reporting is to provide useful information to investors to help them make good decisions. Financial accounting makes this information accurate by following the GAAP rules established by the Financial Accounting Standards Board and the Securities and Exchange Commission. View the next video to see an overview of the basic financial statements and see how investors use the information these statements provide.